The American economy in 2025 is trembling beneath its own weight. Once a symbol of strength, it now faces a wave of economic instability that threatens to topple several U.S. states. With state reserves under 5% and average household debt nearing $45,000, families are struggling to stay afloat. Housing markets have lost as much as $60,000 in value, while key sectors, manufacturing, energy, and tourism, are collapsing, taking over 50,000 jobs with them. Poverty rates above 20% paint a bleak picture of what's to come. Across America, storm clouds are forming over homes people can no longer afford. This isn't a slowdown, it's a reckoning. The American dream is unraveling, and these 10 states are poised to break first when the next recession hits. Number 10. Idaho. Idaho's housing boom turns into a recession risk in 2025. Idaho has been one of the fastest-growing states in America over the past decade, but that rapid growth is now showing dangerous cracks. The state's population has surged to 1.95 million, up nearly 18% since 2015, driving massive demand for housing and straining local infrastructure. During the pandemic-era housing boom, Boise's median home price soared to $483,000 in early 2024, almost double its 2019 level. But now the Idaho housing market is cooling fast. With housing inventory up 28% year over year, home values are slipping, leaving many owners unable to sell without a loss. While Idaho's unemployment rate remains relatively low at 3.9%, it's trending upward amid tech layoffs and a slowdown in construction. The state's economy depends heavily on real estate, agriculture, and technology, three sectors particularly vulnerable to a U.S. recession. Financially, Idaho is underprepared. Its rainy day fund covers just 6.1% of annual expenditures, ranking among the bottom 10 states nationwide. A significant drop in tax revenue could quickly lead to budget cuts for schools, infrastructure, and public safety. Adding to the strain, consumer debt averages $37,200 per household, and 22% of residents spend over 30% of income on housing, leaving them highly exposed to inflation and job loss. Meanwhile, state GDP grew only 0.5% in Q1 2025, signaling economic stagnation. Idaho's pandemic-fueled expansion has turned into a recession risk. With overbuilt housing, low reserves, and a fragile job market, the state is walking a financial tightrope, and one misstep could trigger a steep fall. Number 9. Arizona. Arizona's economic boom turns fragile as recession risks rise in 2025. Arizona has long attracted retirees, remote workers, and sun seekers, but in 2025, the Grand Canyon State's economy is showing serious signs of strain. With a population of 7.4 million, now the 14th most populous state, Arizona's rapid growth has brought rising inequality, inflated housing costs, and an economy heavily tied to service and construction sectors, both highly sensitive to downturns. The median home price in Arizona is $424,000, but in Phoenix and Scottsdale, it surpasses $550,000. With a median household income of only $72,900, more than 31% of residents are housing-burdened, spending over 30% of income on housing. The Arizona housing market, once a symbol of affordability, is now a major financial pressure point. The state's rainy day fund covers only 5.8% of annual spending, far below the 15% benchmark for fiscal stability. In a downturn, Arizona could face painful budget cuts to education, healthcare, and public safety without federal aid. Economic warning lights are already flashing. The Arizona unemployment rate climbed to 5.8% in Q2 2025, with tourism, retail, and construction shedding thousands of jobs. Phoenix alone lost over 19,000 positions between January and May. Meanwhile, state GDP contracted 0.9% in Q1, confirming that growth has stalled. With consumer debt averaging $43,500 per person and delinquencies rising, Arizona's once booming economy now looks over-leveraged and exposed. If a U.S. recession deepens, the state's weak reserves, high housing costs, and job losses could trigger a sharp economic contraction. The warning signs are no longer subtle. They're flashing red. Number 8. Kentucky. Kentucky's economy faces high recession risk in 2025. Kentucky may appear affordable and picturesque, but its economy is showing serious warning signs of vulnerability heading into 2025. The state's rainy day fund, money reserved for emergencies, covers only 7.6% of annual spending, far below the 15% benchmark for financial stability. This limited reserve means that any drop in tax revenue could lead to sharp budget cuts in education, healthcare, and public services. The Kentucky unemployment rate has risen to 5.6%, well above the national average of 4.1%, even before a potential recession. Poverty is another critical issue. Nearly 18% of Kentuckians live below the poverty line, compared to 11.4% nationwide. That's almost 1 in 5 households struggling financially, even in stable times. The Kentucky housing market is also weakening. Although the median home price sits around $213,000, property values are falling, especially in Louisville and rural eastern regions. Continued declines could leave many homeowners underwater, owing more than their properties are worth. Adding to the strain, Kentucky's GDP shrank by 0.7% in the first quarter of 2025. The state's dependence on manufacturing, coal, and agriculture, industries especially sensitive to economic slowdowns, poses a major risk. Coal tax revenues have dropped 22% year-over-year as global demand declines, further eroding state finances. With low reserves, rising unemployment, slowing GDP growth, and widespread financial hardship, Kentucky ranks among the most recession-prone states in America. These are not temporary setbacks. They reflect deep structural weaknesses the state has yet to fix. Number 7. Rhode Island. Rhode Island's economy faces major recession risk in 2025. Don't let Rhode Island's small size fool you. This tiny New England state carries an outsized recession risk heading into 2025. With just over 1.09 million residents, Rhode Island's narrow tax base and limited industry diversity make it highly exposed to economic downturns. The state's rainy day fund covers only 6.9% of annual expenditures, well below the national median of 10.3%, leaving little cushion for fiscal shocks. The Rhode Island unemployment rate has surged to 5.4%, up from 3.6% a year earlier, as job losses mount in healthcare and tourism, 2 of its largest employment sectors. Meanwhile, GDP growth was flat in early 2025, signaling that contraction could be just around the corner. The Rhode Island housing market adds to the strain. The median home price sits around $446,000, far above what most households can afford. With a median household income of $74,489, affordability has reached a breaking point. Rising consumer debt, averaging $41,700 per person, and growing credit card delinquencies highlight the growing financial stress on residents. Many families are now one job loss away from financial crisis. Compounding the risk, Rhode Island ranks near the bottom in pension funding, creating long-term fiscal pressure if a recession forces cuts to state employee benefits. With a high cost of living, fragile job market, weak reserves, and mounting debt, Rhode Island stands among the most recession-prone states in America. If the U.S. economy slides, this small state could stumble first. Number 6. South Carolina. South Carolina's growth masking deep economic vulnerabilities in 2025. South Carolina may appear to be a rising star in the Southeast, but beneath the surface, its economic foundation is showing major cracks. With a population of 5.4 million, the state has become a magnet for retirees, remote workers, and out-of-state migrants, fueling rapid growth that's now straining infrastructure and affordability. The median home price in South Carolina has surged to $388,000, up 52% since 2019, while median household income sits at only $63,900. That gap has left nearly 29% of homeowners and 42% of renters housing cost-burdened, spending more than 30% of their income on shelter. For years, tourism and real estate development powered South Carolina's expansion, but those engines are now sputtering. GDP growth stalled at just 0.2% in Q1 2025, and tourism revenue in Charleston and Myrtle Beach has dropped 11% year over year. Construction starts have also plunged 18%, signaling developer pullbacks. Fiscal resilience is another weak spot. The state's rainy day fund covers only 6% of annual expenditures, well below the national average. Meanwhile, public services are underfunded. South Carolina ranks 44th in K-12 education spending and 47th in healthcare access, leaving little safety net if job losses accelerate. The unemployment rate has risen to 5.7%, with 38,000 jobs lost in early 2025, mostly in hospitality, construction, and retail. Average household debt is $43,800, and credit card delinquencies are up 2.6% year over year. With a fragile housing market, low fiscal reserves, and heavy reliance on volatile service industries, South Carolina's economy is dangerously exposed. If a U.S. recession hits hard, the Palmetto State could face a rapid unraveling, especially for middle and lower-income households driving its growth. Number 5. Mississippi. Mississippi's economy on the brink as recession fears deepen in 2025. Mississippi consistently ranks near the bottom in economic resilience, and in 2025, the state is perilously close to collapse. With a population of 2.9 million, Mississippi holds the highest poverty rate in the U.S., 19.9%, compared to the national average of 11.4%. That means nearly 1 in 5 residents lives below the poverty line, even in stable times. The state's rainy day fund covers just 5.2% of annual expenditures, among the lowest nationwide, leaving Mississippi with almost no fiscal capacity to withstand a U.S. recession. GDP contracted 1.2% in Q1 2025, led by steep declines in agriculture, manufacturing, and healthcare, 3 pillars of the state's fragile economy. The Mississippi unemployment rate has climbed to 6.1%, with job losses concentrated in Jackson, Tupelo, and the Mississippi Delta. Meanwhile, rural hospital closures are accelerating, deepening the state's healthcare crisis. Mississippi ranks 49th in healthcare access and 50th in education funding, severely limiting its recovery potential. The median household income is just $51,500, while median home prices hover around $184,000. Despite appearing affordable, over 34% of residents are housing cost-burdened, and credit card debt averages $38,200 per household. Compounding these issues, more than 1,000 bridges are structurally deficient, and major water systems, including Jackson's, are in critical condition. With high poverty, collapsing infrastructure, low reserves, and a weak job market, Mississippi's economy is teetering on the edge. If a national recession intensifies, the Magnolia State could plunge into a full-blown economic spiral, one from which recovery may take years. Number 4. Indiana. Indiana's manufacturing backbone weakens as recession fears grow in 2025. Indiana may be the heartland of America, but in 2025, its economy is showing deep structural stress. With a population of 6.85 million, the Indiana economy is heavily dependent on manufacturing, especially automotive and steel production. Industries now reeling from reduced demand, rising interest rates, and global supply chain disruptions. The numbers tell a grim story. State GDP shrank 1.1% in Q1 2025, while factory output dropped 6.7% year over year. The Indiana unemployment rate has surged to 5.9%, with over 42,000 jobs lost in the first half of the year. Major employers in Elkhart and Fort Wayne have initiated rolling layoffs as factory orders stall statewide. Labor force participation has slipped to 60.8%, its lowest in a decade. Although the median home price of $246,000 appears affordable, median household income sits at just $63,000, leaving many families financially fragile. Consumer debt now exceeds $41,000 per household, up 12% since 2022. The Rainy Day Fund, covering only 6.4% of expenditures, offers minimal fiscal protection. Indiana's social safety net is notably weak. The state ranks 45th in public health spending per capita, and its unemployment benefits are among the lowest in the nation. The housing market is cooling fast, with rising vacancies, longer listing times, and evictions up 22% year over year. Renters, making up 1/3 of residents, face the greatest strain as wages stagnate. With manufacturing faltering, low reserves, and mounting debt, Indiana's economic foundation is cracking. If a U.S. recession deepens, the state could face a severe industrial and employment collapse, a reminder that when the factory belts stop moving, Indiana stands on economic quicksand. Number 3. Nevada. Nevada's economy faces high stakes as recession pressures mount in 2025. Nevada's economy has always been a gamble, and in 2025, the odds are starting to turn. With a population of 3.2 million, the state remains heavily dependent on gaming, tourism, and hospitality, sectors that quickly crumble when consumer spending slows. Early signs of a U.S. recession are already hitting hard. Las Vegas tourism revenue has dropped 13% year over year, with hotel bookings and convention attendance plunging. The Nevada housing market is also cooling. The median home price sits at $438,000, but prices in Las Vegas have fallen 8.7% year over year. Pandemic-era investors are exiting fast, driving housing inventory up 34% compared to 2023. Nearly 19% of Vegas homeowners are now underwater, owing more than their homes are worth. Financially, Nevada's Rainy Day Fund covers just 5.1% of its budget, the second lowest in the nation, leaving the state dangerously exposed. With gaming and sales taxes accounting for over 60% of revenue, a tourism slowdown could trigger a fiscal crisis. The Nevada unemployment rate has risen to 6.3%, with Las Vegas losing 22,000 jobs between January and April 2025, primarily in casinos, hotels, and entertainment. Meanwhile, consumer debt averages $45,200 per household, and delinquency rates on auto and credit card loans have climbed 2.3% in 6 months. Even beyond Las Vegas, Reno and Henderson are feeling the pressure as real estate softens and service jobs disappear. With low reserves, high debt, and over-reliance on volatile industries, Nevada is among the most recession-vulnerable states in America. And in this economic game, there's no safety net. Number 2. Louisiana. Louisiana ranks as the most recession-vulnerable state in America for 2025, and the warning signs are impossible to ignore. With a population of 4.6 million, the Louisiana economy faces a perfect storm of extreme poverty, collapsing infrastructure, shrinking revenues, and minimal fiscal reserves. The state's rainy day fund covers just 4.3% of annual expenditures, the lowest in the nation, barely enough to sustain basic operations for a few weeks if tax revenues decline. Meanwhile, state GDP fell 1.4% in Q1 2025, one of the steepest drops nationwide, as energy prices fell and offshore drilling slowed dramatically. The Louisiana unemployment rate has surged to 6.6%, with over 54,000 jobs lost since January. Key sectors, oil and gas, tourism, and shipping, are all contracting. New Orleans has shed 15% of its hospitality workforce, while Baton Rouge has seen construction halted on more than 60 major projects. The median household income is just $54,000, compared to a median home price of $225,000. In rural parishes, incomes often fall below $40,000, and infrastructure is crumbling. Nearly 23% of residents live in poverty, the second highest rate in the U.S., while 40% of renters are severely cost-burdened. Average household debt sits at $42,000, with credit delinquencies climbing and rising insurance and utility costs pushing families to the brink. With the state ranking 48th in healthcare and 46th in education funding, Louisiana lacks the public resources needed to weather another downturn. If a national recession deepens, Louisiana isn't facing a slowdown, it's facing systemic collapse. The cracks are already visible. The crash just needs a trigger. Number 1. Colorado. Colorado's economy faces a harsh reality check in 2025. Once considered one of America's fastest-growing economies, Colorado is now grappling with the side effects of its own rapid expansion. With a population of 5.9 million, the Colorado economy has seen sharp increases in home prices, household debt, and income inequality, transforming a growth success story into a potential recession risk. The state's rainy day fund covers just 5.9% of annual expenditures, far below the level needed to cushion a downturn. Despite a diverse economy, much of Colorado's recent prosperity has been real estate-driven, and cracks are beginning to show. The median home price in Denver has soared to $631,000, while the statewide median sits near $570,000. With a median household income of $84,000, nearly 37% of homeowners are cost-burdened, and rents have jumped 28% in only 2 years. The Colorado unemployment rate has climbed to 5.4%, with layoffs spreading across tech, construction, and tourism. The state GDP contracted 0.6% in Q1 2025, and analysts warn that energy and outdoor recreation, two of Colorado's key revenue drivers, are highly vulnerable to an extended recession. Meanwhile, consumer debt averages $48,900 per household, and credit card delinquencies are up 3.1% since late 2024. Many millennials who relocated to Denver, Boulder, and Fort Collins for opportunity are now struggling with high living costs and job insecurity. Public resources are stretched thin. Colorado ranks 42nd in per-student education funding, and homelessness is up 21% statewide. With low reserves, growing inequality, and an overheated housing market, the Centennial State is headed for a sharp economic correction, and this time, even the mountains can't shield it.